So suppose I'm saving towards retirement. I'm 30 years old. I'm going to retire at 60. I have 30 years to invest. That means the money that I'm setting aside for retirement, I could put that money more at risk because I have a lot more time to withstand short-term fluctuations with the objective of having a longer-term higher return over the 30-year period. So don't only look at your willingness to accept risk, but also where you are positioned from an ability perspective.
Let's start with some very good news, Crystal. We're seeing all of the developments that have been shared by the executive director, also by the CFO, and we're also seeing higher returns in our income funds, particularly in 2024. What has been driving this performance? And also, let's talk a little bit about that term, balanced funds.
Sure. So good morning, everyone. It's really a pleasure to be here this morning to provide a little bit more context on what's been happening in the markets and how it's been impacting our investment portfolios. So Hema, to your question on 2024, and I know it came up in Nigel and Kerry's remarks. Before we go into the fund performance, I just want to show a little bit about what happened in the market and how that impacted the portfolio returns. So I want to start with international equities. And you would see here in 2024, the market was actually up 23%. So that's the S&P 500, which is a representative of the top 500 companies in the US. While here at home, our local equity market was actually down 12%. Over on the fixed income side, in the US, the Fed funds rate, which is the interest rate used by their central bank to manage inflation, moved down 1%. So that is normally in a band. So it moved from 5.25 to 5% down to 4.25 to 4.5%. And then here at home with the TT repo rate, which is the equivalent of that Fed funds rate, that actually remained unchanged and is at 3.5%. So how did that impact our investment returns? So to go to the balanced funds first, so our two largest balanced funds, the Growth and Income Fund and the URF, you would see here over the period 2022 to 2024, we started 2022 with negative returns of minus 10.8 and 9% across those two funds, and that was driven by the underperformance of the local equity market. So those funds have domestic equities, international equities, local fixed income, and international fixed income. So everything that I showed on that slide earlier actually will impact the performance of these particular funds. So you'd see in 2023, we had marginal positive performance. And then in 2024, we had a marginal decline, again driven by the underperformance of the local equity markets. Now, while the local equity market would have been down 12%, some of those losses would have been mitigated by how diversified those portfolios are. So we did have contributions from the international equity component as well as the fixed income component. Going over to the fixed income funds, which is a better story, of course, which you heard in the presentations before. We have seen the payout rates increase on these funds. So in 2022, the US dollar income fund would have been paying just about 1%. And at the end of 2024, we were up over 3%. Right? On the TT dollar income fund, we started at 1.15, and at the end of last year, we were up to 2.85%. So despite the decline in short-term rates in the US and the repo rate remaining unchanged, we did see ticks up in longer-dated securities. So we were able to reposition the portfolios to really benefit from higher income, which we've passed on to you, our unit holders.
Well, our unit holders are always happy when they benefit from the benefits that you benefit from. Now, Crystal, you talked a little bit about it's no reality, the lagging of the local stock market and what's happening there. You made reference to the equity market in particular. Building on what you've said, the stock market, local stock market, has not had the best run in recent times. What is behind the underperformance?
So Hema, I know we're supposed to have 15 minutes, but this might probably take all day, right? But our local equity markets, as you said, have not been performing lately. For the past 3 years, we've been seeing declines in that market. Essentially, it boils down to the composition of the investor base in our markets, as well as the inherent illiquidity of the markets. So when we think about the investors in the local equity space, it's made up mainly of institutional investors which will be, like ourselves, mutual fund providers, pension plans, insurance companies. Now, they tend to be responsible for the most of the trading that happens on the stock exchange. But because these plans and these firms are so large, when we have a block of securities that we could buy, we tend to have a buy and hold approach. One, because if we want to sell it, we may not get the price that we want for it, and then that impacts the returns on the stock market. Or two, if we sell it and we need to buy it back, we possibly won't be able to get it back. So that has led to a really buy and hold approach from institutional investors, which has reduced demand on local equities. And then when you look at retail investors, only about 3 in 100 persons in Trinidad and Tobago invest directly in the stock market through brokerage accounts. So the activity that you're going to get from those retail investors is really minimal. So overall, we have a lack of demand in the markets. And then when you look at the alternatives, so for those who have access to US dollars, you would probably prefer to have your monies invested in a more liquid market like the US stock exchange, which is performing and which is providing better returns. So the underperformance really isn't capturing the audience. We also have a very risk-averse investing public. We tend to focus more on the fixed income funds and not necessarily putting our capital to risk in funds such as the Growth and Income Fund and the URF. So I know there are a number of stakeholders throughout the market who are working on various initiatives to bring more activity to the stock market. But at UTC, we've been doing some of our own work in order to enhance what's happening. And Nigel would have spoken to it in terms of financial literacy, which is core to our mandate, and really educating the public about the benefits of long-term investing and stock investing. And that's whether it's through direct investing or through mutual funds such as ours that have an equity component. And we've also been doing a lot of work with entrepreneurs. So our Scale-Up program, which we mentioned earlier as well, that really positions these small and medium enterprises to scale up, as the name implies, and to really be on a trajectory of growth and possibly position those companies to be the next blue chip companies in Trinidad and Tobago, and possibly be listings in the future that we could actually invest in.
Well, I'm looking directly at the Scale-Up alum there, so I know some challenges will be thrown your way, so we're hoping to see you list very, very soon. We also have representatives from the stock exchange, but our CSRs can also help you with that process. Now, Crystal, one of the big questions recently, if you look at the international news, we've seen the US elections and what has come out of that, but the big news dominating the financial sector has been this talk on tariffs and the ripple effect on the markets. How has that impacted or will impact a unit holder's investment strategy and UTC's investment strategy?
Sure. So, Hema, there's been a lot of talk in the news, in the market about tariffs. And just to make sure we are all on the same page, so a tariff in its simplest form is essentially a tax that a government imposes on imports of goods into its country. So in the case of the US, they have imposed taxes on imports coming from countries outside of the US. And the reason that they have done this is to really make goods that are produced in their country more attractive as it relates to the prices of those goods. Because if you have to pay a tax on the imports, it's likely going to be more expensive than buying something that is produced in the US. So they would have, for instance, imposed tariffs on motor vehicles. So motor vehicles imported from Europe, Japan, China would likely over time become more expensive than automobiles produced in the US. So they're really trying to refocus their consumers on goods produced in their country and to reduce their import bill. So what does that mean for the economies, the stock markets, and our portfolios? Now, on April 2nd, what they termed Liberation Day, they announced tariffs across all countries. And because of the uncertainty and, in some cases, the scale of those tariffs, the market became really jittery about the impact on economies, both the US and the global economy, because it will impact trade as well as inflation. Right? So we've seen a lot of swings in the markets. Since then, there's been a pause on the tariffs, and the US has welcomed negotiations with different countries. So because we still haven't settled on where the tariffs are going to lie and what the actual impact is going to be, there's a lot of volatility in the market. So you would be seeing the prices of your funds, but particularly the Growth and Income Fund and the URF, fluctuating. But I want to show a chart here of a long-term performance of the S&P 500 between 1994 and 2024. And this chart here shows a number of events that happened throughout this period, whether it was economic events, health crises, geopolitical events. And you would notice the little ripples in the chart would be volatility that we experience. But over the long term, you would notice that the trend is positive. So even with the volatility in the markets, which is not new, it presents opportunities for us. We look for securities that become undervalued when the market sells off, and we acquire these securities, to position the portfolios to benefit us for when the market rebounds. So this volatility is not new to us, and we just continue to get opportunities from what we're presented with.
Well, it's good to know that UTC continues to identify the silver lining in all that's happening. Now, the markets, as you said, have been anything but calm. We've used the term volatility and uncertainty that has been dominating the news cycle. We're here talking about 2024 performance, but I think a lot of people would wonder, what does 2025 look like?
Yeah, so Hema, I agree with you. I think the tag word for 2025 is uncertainty. So let's look a little bit now at how this has impacted the portfolios so far. So going back to the balance funds, the top bars will now represent the year-to-date performance as at April 30th. So you would see for both the Growth and Income Fund and the URF, we do have slightly negative performance on those funds, and that would have been as at April 30th, driven again by the international equities, which were negative as at that date. Local equities were also negative as at that date. But we did have a buffer from the fixed income component, which provided some stability and income to the portfolio. So the returns year to date are marginally negative. On the fixed income side, we're happy to share that we continue to increase the payout rates. So on the US dollar income fund, we're now up to 3.35%. And on the TT dollar income fund, over 3% being paid out as at May.
There should be a round of applause for the increased payout rates. I feel like I have to keep cueing this applause center. Now, Crystal, we just have about 3 minutes. For unit holders who are concerned, and I don't want to be saying it ad nauseum about this term volatility and uncertainty of their investment, what advice do you have for them? Because everyone is different. Some people may see 1% or 0.0%, and they're calling the advisors. I see Shuan and his team there. They're ready to go on the phone with them.
So, Hema, I think it's totally natural and understandable for anybody to be worried about volatility, particularly when it relates to your money. Nobody wants to see their balances decline. But I want to encourage you as investors and our unit holders to look at two factors. One aspect of risk tolerance is your willingness to accept risk, and that is how comfortable you are with risk. So am I comfortable with seeing fluctuations in my money? So that's sort of your aversion to risk. But on the flip side, there's also your ability to withstand risk. And a lot of people do not look at this aspect. So this takes into account, for instance, what am I investing towards? What is my investment horizon? How much capital do I have? Right? And then looking at those factors, so suppose I'm saving towards retirement. I'm 30 years old. I'm going to retire at 60. I have 30 years to invest. That means the money that I'm setting aside for retirement, I could put that money more at risk because I have a lot more time to withstand short-term fluctuations with the objective of having a longer-term higher return over the 30-year period. So don't only look at your willingness to accept risk, but also where you are positioned from an ability perspective. And if you want to talk more about it, please feel free to come in. We have investment advisors that could go through this with you and let you know where your risk tolerance falls and which products are right for you. So you may even realize some of you may be in a TT dollar income fund, which is one of our more safer products, but you possibly should be having some of your portfolio in the Growth and Income Fund and the URF because you have the ability to withstand risk. So come in and talk to us and we can have that conversation about your risk tolerance.
Just don't be emotional about it. When Crystal mentioned the time to retirement and your risk, I realized that mine is shortening. So I may have to have that conversation as well. But Crystal, we just have a couple seconds again. Looking ahead, what's the outlook for the rest of the year? What are the opportunities existing?
So Hema, as we said before, there continues to be a lot of uncertainty, particularly in the international markets. But I want to show you a slide that highlights our investment philosophy. So this is a chart of the S&P 500 for the year-to-date period. So you would see we started the year at just around 6,000. And when we had the announcement of tariffs, we had a large decline just around April 2025. Now, a lot of people would have become scared at that time and exited the markets. But look what happened after that. A few weeks later, the S&P is almost back to where it was at the beginning of the year, right? So our philosophy is that time in the markets is better than trying to time the markets. So we continue to use these bubbles of volatility to look for securities that we could add to the portfolio and benefit you in terms of higher returns once the long-term trends come back into place. So we just continue to monitor and make strategic decisions based on the market movements.
Understand that term. Time in the market is better than timing the market.